Hello, everyone. Hope you are all having a great day. Thank you so much for making the time to be here. I know everyone has a lot of things going on towards the end of the year with the holidays and just getting complete so you can all have a break and enjoy the holiday season. So I wanted to give it a couple more seconds to allow people to get back in. We will be, as you can probably see, recording this so you can go back and reference anything that we've shared, digest it, share it with other people just to make sure that they're getting this information. But we wanted to have a recap and basically a rapid fire session where we're going to touch on, from a high level, year end, kind of last minute things that can still happen. We still want to make sure as advisors and planners that you are proactively looking ahead so that you're not having to do things in the 11th hour. But nonetheless, there are still things that can be done. And sometimes new information comes along that you're able to then take advantage of, or things change from a couple months ago that now create new opportunities. So that's the point. We can't get into every last specific detail and technicality about all the things on this list during our time together. So either way, we'll be putting some information out there. Feel free to try and put some questions in the Q&A box or chat box and do my best to answer them. Yeah, thank you. The entire Illumination Wealth team was very instrumental in putting this together. We've been dealing with a lot of different things, a lot of different families and business owners and retirement plans, and all of these have shown up in some way, shape, or form for our clients. And so these are some of the key things that can be done between now and the end of the year. So I'm going to share my screen and we will hop into the presentation. So remember that this is really general education. I just want to know that this is not personalized tax advice. These are things that you know that are part of the tax code for you to be aware of, that you can go off and consider and look to implement if it fits for your specific situation. So if it doesn't, it doesn't. If you have questions, please follow up with me or anyone else in the Illumination team, as well as your CPA or tax advisor. Our role here really is to integrate your personal business and finances holistically to ensure that you're making the best decisions and enhancing the returns across your entire financial life. Tax is a huge opportunity. Many of our clients are very successful, high income, significant investment portfolios, and those things generate tax. And tax is, in many cases, the number one thing in a person's budget. Like, they don't even think about it as a spending, but it is significant. If you're in California, New York, Minnesota, some of these high tax states, 50% of your income could be going to taxes. So it's important that in order for you to make the biggest impact, that we want to ensure that we minimize these so your money can go to your financial life and the things that you value most, or charitable causes, and all of those things that matter to you. So what we're going to touch on today, really from a high level, is family and marriage tax planning, just really understanding how your marital status, your family decisions can significantly impact your taxes, some strategies around that. We'll be discussing some business and retirement strategies. So we'll dive into tactics for business owners, including medical plan tax strategies, retirement plan contributions, tax credits, and so that we can be managing business expenses and deductions for maximum tax efficiency. And then we'll also talk about investment deductions, vehicle deductions, so how we maximize and optimize your investment portfolio, vehicle purchases that you might be doing, whether it's for business or personal use, and roll from there. So look forward to diving in. Let's just start off here. I'm going to be referencing some things as we get into it on another page. But one of the things, there's just timing situations. We have clients that are getting married, or some clients that are unfortunately getting divorced. But December 31st is really the cutoff date. That if you are going to be getting married in this year, what your marriage situation for December 31st tells, is your tax reporting status. So if you're married, you're married. If you're getting married in January, get married in December, you get to file married filing jointly, which in many cases will have its benefits, versus if you are no longer married, you could be filing a single or head of household if you have children or the like. So the timing of these specific situations will impact your tax situation. So probably not really applicable to many people, but some other things that I want to think about as this has showed up for many of our clients recently. That's making use of the zero tax bracket when you are gifting money to family or people that you support. And we want you to be thinking about how you are gifting to those people that matter most to you. And you could use what we call kind of a zero tax strategy for gifts that are not going to your children. And let me give you an example. So we have a client of ours who supports their mother-in-law. They have an investment portfolio that is appreciated significantly. Their family members are in very, very low tax brackets. They have very nominal income from Social Security. So they're basically, they have very, very low income. So right now, what can happen is that you have the ability so basically, if you think about it, there's a 0% capital gains tax bracket. So that applies to a single person with less than call it $45,000 of taxable income. And for a married couple, $90,000 approximately a taxable income. So if you had the standard deduction on top of that, we're talking a married couple would be paying no capital gains tax up to about $120,000 of adjusted gross income. So if their income is modest and you are supporting them and you have a stock portfolio that has appreciated, you could gift them your appreciated stock. They can then sell that stock that had a huge gain and pay no taxes on it, as opposed to you using after-tax dollars or selling your stock that will then create a capital gain and then create a capital gain tax for you. And so you're just finding ways to utilize your existing resources to maximize it and minimize taxes. So think about it this way. You give your mother-in-law stock with a fair market value of $20,000. Let's say you paid $2,000 for this and it was Tesla from, 7 years ago. So your mother will now, your aunt, mother, whoever can sell the stock and pay zero capital gains. So she'll be left with $20,000 in the bank account because there'll be no tax. Meanwhile, if you would have had to sold the stock for some other purpose or for this, you're going to be paying $4,000 to $5,000 of tax or more between Fed and state on that same $20,000. So it's better to be gifting to those in low tax brackets. Something to definitely consider for those of you that might be supporting people in low income tax brackets. And then also put your children on payroll. Find ways to hire your children in your business. And you can do so by, if you have an LLC or a family management company, you can save on payroll taxes by doing this. You can also shift income, because if you're in the 37% federal bracket, they're in the 0% tax bracket. You can, basically avoid income tax 37 to 50%, depending upon where you live. And then you can also provide for their Roth IRA contributions on that income. So highly strategic to put your kids on payroll. We want to make sure that they're being paid reasonably. They have documentation like any other employee of your company, W-4s, I-9s, all filled out. And then they have their own bank account where the payroll gets deposited into. And then you can utilize their money to fund IRA contributions. You can utilize that money to pay expenses that you already were for their life, whether it's camps or soccer clinics, soccer teams, so that you're turning pre-tax, turning after-tax expenses into tax-deductible expenses by having your children on payroll legitimately. So you got to think about ways, if you have a 1-year-old, how you can pay them reasonably. It's different than if they're 10, 12, 14, 16, that have the more ability to work in your business. So those are some family and relationship, tax strategies to share. Wanted to then jump into some medical plan tax strategies. So for those of you, thinking back, it's already been 3.5 years since since COVID, but there are federal tax credits that equal 100% of the required 2020 and voluntary 2021 emergency sick leave and emergency family medical leave payments. And so you have the ability now, if you made any of those payments, you're gonna have to dig into your records to understand the situation more specifically. But if that has happened, you can go back and amend your returns to then qualify for those credits that you may have forgotten about or, didn't really know. So that's something else to consider. So another medical plan strategy, this is oftentimes more effective for those that have C Corps, or if they have a C Corp, and they are the kind of the sole employee shareholder, setting up and maximizing your Section 105 plan. Basically, this is a qualified medical plan that allows you to reimburse yourself on a pre-tax basis for medical expenses. And so we want to make sure if you have that plan that you do the reimbursements for your qualified medical expenses by the end of this year. Not everyone can have these plans. Doesn't really work for S Corps, but those with C Corps, it does. And so they can be pretty powerful if you think about having these plans in place. And why is it? Because basically you can take all of your medical expenses and get a tax deduction for those payments. And that could be for therapy, that could be for prescriptions, it could be for any of your out-of-pocket qualified medical expenses can be subject to reimbursement. So for a family, there could be tens of thousands of dollars of medical costs that can now get deducted under a Section 105 plan. So if you have one, make sure to reimburse yourself. If you don't have one, find out if you qualify to put one in place potentially for your company in the future. So that's another big one to be considering. So there are also different tax credits out there when it comes to group health insurance. And so you need to see, this could be state by state. You can see whether your pay structure and the number of employees that you have put you in a position to claim a 50% tax credit for some or all the monies you paid for health insurance in 2023 and potentially in prior years. So you're going to need to work with your group health insurance provider to get all the details and the records and then determine whether or not you file, whether or not you qualify for that credit. So something that could be out there that you weren't aware of, and hopefully your benefits broker was discussing this with you and you were communicating this information to your CPA to ensure that you were getting the tax credits that you would be legally entitled to. And then S Corp health insurance tax deduction. This is one of those things where we don't see people necessarily setting up their S Corp health insurance tax deduction properly, and we want to make sure that you get the benefit. So if you own an S Corp, like many of our clients do, if you're a 2% or greater S Corp owner, you can't simply write the health insurance expense that the company pays on your behalf off as a business deduction. There's a specific process that needs to happen. And so you need your S corporation, one, to pay your medical insurance or reimburse you for your health insurance. And then you need to put that insurance cost on your W-2. So your W-2 needs to be kind of grossed up for your health insurance premium. And then what happens is that your W-2 will get that income on your W-2, but then there's going to be a health insurance, self-employed health insurance deduction on your 1040, on your individual tax return. And so you should be structuring this correctly and making sure that it's all set up properly through your payroll, 2% healthcare, health insurance or medical insurance on your payroll, your W-2, and so that the tax deduction gets picked up accurately. And the other part about doing this correctly is that for many clients and business owners, they want to take as low as salary as possible from a reasonable compensation standpoint. The IRS wants you to see reasonable compensation, and what this is if you're the owner of a company and your business has $1 million in net income and you work actively in the company and only take a $20,000 salary, they're likely not going to see that as reasonable compensation. So you need to pay yourself adequately, but you don't want to pay yourself too much and continue to have to pay payroll taxes on that income or Medicare taxes on that income. So you need to take reasonable compensation. The S corporation health insurance cost that gets grossed up into your W-2 is part of that reasonable compensation. And so you can potentially reduce the amount of cash compensation wages that you take, knowing that there's going to be a $15,000 or $20,000 health insurance gross up due to this 2% health insurance situation. So those are things that you should be thinking about from a medical plan strategy towards the end of the year. Now we want to get into retirement plan tax deductions. Hopefully you've already been thinking about this, but you can either establish or upgrade your retirement plans right now. Are there things that you need to do to set something up so that you can maximize a contribution for this year? For example, certain companies would need to have, if you have an S Corp, you need to make sure that your 401k plan is established by 12/31. You also need to make sure that if you're an S Corp, that you take the appropriate salary and wages to be able to maximize those contributions. So some of the plans, depending upon your structure, you might have the ability to actually set up into 2024 for the tax year 2023. But there's also nuance to that. For example, if you have a 401k plan at your company and you want to set up a cash balance plan that would allow somebody 40 years old to put away over $100,000 additionally in pre-tax deductions, you need to make sure that those two plans can talk to each other and that that the setup of the cash balance plan can actually work with the structure of the 401k plan. So even though a cash balance plan could be established after the end of the year, technically, it might not work if you already have a 401k plan, depending upon that plan design and the third-party administrator of that company. So definitely be thinking about your retirement plans. And then as you think about those retirement plans, there are startup retirement tax credits that happen. So, if you have multiple employees and you haven't done a retirement plan, there are tax credits that you can be getting based on the number of employees participating in the plan, based on if you're providing a contribution on the employee's behalf, based on if there's automatic enrollment features, there's tax credits that you can be claiming by starting up your plan. So instead of all the costs going towards the third-party administration and the record keeper, you actually can get, in some way, shape, or form, paid to set these plans up. So something else to be very aware of. And then there's another credit, the employer pension contribution credit, where there's up to $3,500 credit per employee. For example, let's say you establish your retirement plan and contribute $1,000 to each of your 30 employees. You can earn a tax credit of $30,000. So it's worthwhile to understand what you have, what you're doing, what you want to do, and make sure that you're connecting the dots, that if you do start a 401k plan or did start one up this year, that your CPA or tax preparer is aware of that so that they can actually claim the credits. There's been far too many times where the CPA isn't aware of these changes in tax law, and then these tax credits are going to waste. So something very important. All those lines of communication need to be in place to make sure that you are getting everything that you're entitled to. And another retirement planning strategy that we see for people, which is very applicable for those in low income years, is to convert their pre-tax accounts to a Roth IRA. So you need to answer some questions first. How much tax are you going to pay to convert your existing IRA account to a Roth IRA? If you know that answer, if you're doing tax planning and tax projections, you're going to know how much cash you might need to pay that extra tax. And perhaps if it's done correctly, there might be no tax due because of your situation. Let's say that you're in the real estate industry and your taxable income was zero this year or negative for some reason. You could convert your IRA to a Roth, and that conversion will be treated as ordinary income. But if your income's negative, you might pay $0 in tax on that conversion. Now, all of a sudden, your money is tax-free forever. The growth of that account is tax-free forever. So we want to strategically use low income years to be making these decisions, or converting your Roth IRA, or accelerating distributions from an inherited IRA. Not everything that I'm saying is a bullet point on here, but they're all related concepts. And so that's why it's really important to do your tax projections to know exactly where you stand. So that's on the retirement plan tax deduction. We'll talk a little bit more about related concepts in a few minutes. So investment portfolio tax strategies. These are things that we've talked to people a lot about, and different opportunities based on different tax situations for everybody. But we want to be really managing our capital gains. And so part of the things that you want to do is, some clients, strategies have short-term gains, or they had short-term gains for some reason with a prior investment advisor. And the reality is those short-term gains are treated at your highest tax brackets. So for people, just general concept, if you're thinking about a very actively traded investment strategy in a taxable account, you could be paying 37% taxes versus 20% taxes on long-term capital gains. So there's a significant hurdle that you need to create in terms of performance to offset the lower long-term taxable capital gains tax brackets. But either way, if you have high tax short-term gains, you could take losses with long-term losses, which are taxed at 20%, and use those losses to offset your highly taxed short-term gains. So this is all similarly in related concepts. We could also do additional loss harvesting. You could be selling your underperforming stocks, mutual funds, exchange traded funds to offset gains in other areas. You could also be using it to reduce taxable income. And what that does is you can use losses to then create a $3,000 deduction against all your other higher tax bracket ordinary income. So it's a possibility. You can also use loss harvesting to get out of tax inefficient and high cost investments. Many times we're reviewing clients' portfolios and they have tax inefficient investments in taxable accounts, while those tax inefficient investments could be held in pre-tax accounts and shield that tax inefficiency in those tax protected accounts. So by applying these harvesting methods where we're going to sell realize losses here, maybe sell this tax inefficient thing that had a gain and then put it and repurpose it into a different account to ensure that the tax efficiency of the entire portfolio is looked at holistically. Other times you can, if there's lots of capital losses, same thing with the harvesting situation, you could sell other things. You could sell additional stocks. You might have a rental property that you sold. You might have a gain on your house that you, from owning it for 10 years and the appreciation was way more than the $500,000 exclusion, that these losses could offset the gains from those other, transactions that are happening in your financial life. So those things are really things that you want to be thoughtful about. And then we also think about strategic charitable donations. And so similarly to like gifting money to family members, instead of gifting cash, you can be gifting appreciated stock. So what is the benefit of that? Well, instead of selling a security at some point in the future and then paying cash, and then selling it and paying the tax to then donate cash, you can simply donate that stock that's appreciated instead of cash. And the benefit is that one, you're not going to ever pay the capital gains tax on that appreciation. Two, the charitable organization doesn't have to pay the gain on that. And so if you donate $100,000 directly to charity, depending upon your income, you're going to be able to deduct that entire $100,000. You don't pay any capital gains tax. They don't pay any capital gains tax. And so it really makes your money go farther because now you have higher basis dollars to then reinvest. So, and the same thing as we touched on before, where you could be setting up donor advised funds now. And if you had a high income year, you could be donating appreciated stock and bunching your donations all into one, into this year. So let's say this year had a significant capital gain event or an ordinary income event where your income was dramatically higher than normal, and you are somebody that gives to charity each and every year. You have a specific plan or a specific program. You can fund a donor advised fund this year, donate your appreciated stock, donate cash, what have you. And let's say you give $50,000 per year. Instead, you might think about donating $500,000 this year, getting the deduction while you're in these highest brackets, and then using that donor advised fund to make the grants over the next 10 years. So instead of perhaps giving another $50,000 next year when you're in lower tax brackets, you use this year's tax situation to maximize the tax impact, but still use the donor advised fund to make the grants on the time frame that matter most to you. And same things, you can also be giving appreciated stock, as we shared, to your parents and then selling them at their lower brackets. So those are some investment portfolio tax strategies. There are now let's talk some general business income deductions. This might not be applicable to everybody who doesn't have a business, but with most of our clients being entrepreneurs, this is an area where there's oftentimes significant opportunity in the business arena of our life. We're allowed to take personal expenses and make them business expenses when structured properly. Nonetheless, what are some of these deductions right now to be thinking about before year end? One, there's the state and local tax deduction workaround. As you know, in 2017, tax laws changed where we couldn't deduct our state and local taxes beyond $10,000. If you live in California, you own an $800,000 home, you're paying $10,000 in property taxes. You also have your state of California taxes, sales taxes. you can no longer deduct anything above that $10,000 limit. But now many states have enacted these workarounds called the pass-through entity elective tax. Each state has their own election requirements of how you have to go about doing this. But for example, Hawaii recently enacted their pass-through entity elective tax. So for example, there are 11% tax brackets in the state of Hawaii, which is pretty significant. So if your business makes, let's just say it makes $500,000 of net income, you would pay 11.3% of that, which is your estimated state tax, through this pass-through entity elective tax. So you'd be making a $50,000 payment to the state of Hawaii through your business, through your pass-through entity. And then that reduces your net income. So then it reduces your federal net income by $50,000. And if you're in the 37% tax bracket, that's saving you another $18,000, $20,000 in tax federally by using these pass-through entity elective tax. There might be 30 plus states that now have this. Each one has their own rules. And so even though you might not have money due, until April 15th, if you're cash basis and the like, you might want to be making these payments by the end of this year, if possible, under the elections that you choose, so that you can get the deduction during this actual calendar year from a tax standpoint. So something to think about. Other people, you might want to be prepaying business expenses. If this year was a high income year, you can use the IRS safe harbor method to prepay and deduct expenses for up to 12 months, whether it's insurance premium payments, whether it's rent. Not saying that you want to do that. This is all a cash flow management situation. But perhaps there's expenses that you might want to prepay or bring forward instead of doing it in the beginning of next year. If income might be lower, we're going to shift that expense into this year to reduce your taxable income. Similarly to that, you can be using your credit card wisely. So if you're a single member LLC or a sole proprietor and you file a Schedule C, the day that you charge a purchase to your business or personal credit card is the day that you deduct the expense. So even though you might not be paying the payment till next month, you get the deduction on the day that you charge it. And so if you operate as a corporation and the corporation has a credit card in the corporate name, the same rules apply. The date of the charge is the date of the deduction. So even though you charge today, you don't make the payment for 30 days, you're going to get that deduction in this tax year. So things to be thinking about. Beyond that, there's also just strategic billing and invoicing. Depending upon your income situation, you can either delay billing to shift the income into the next year where you might be in a lower tax situation, or by bringing it in because you're low this year and you want to, accelerate your income to be taxed at a lower tax rate this year. Beyond that, there's just investing in equipment that you can be doing. You can be taking advantage of Section 179 and bonus depreciation. So you can be getting immediate write-offs for equipment purchases versus having to depreciate them over time, whether it's new computers, new furniture, new equipment for the office. And I think the other thing that people need to be aware of is don't just assume that you're taking too many deductions. Your deductions are your deductions. You get to claim your rightful tax deductions. So document them. Make sure that you're taking advantage of them. And if you can't use them all this year from a tax perspective, it's okay, because now you get an NOL and you can use that net operating loss carryover in future years when your income scales and grows again. So don't worry about taking too many deductions. Just take the appropriate ones that you're entitled to. So this is also another business-related tax strategy, and it's related to Section 199A, which is the qualified business income. And the qualified business income is essentially a 20% lower tax bracket for pass-through entity businesses like an S-Corp. And so the qualified business income has phase-outs. So if you earn a certain amount of net income, you lose that 20% lower tax rate, which is pretty significant. So if somebody's in the 37% tax bracket, qualified business income will be at about 29%. So definitely meaningful, but you need to understand your tax situation, whether you're a specialized service business or not. And then there's things that you can do to be reducing your business taxable income to help you qualify then for QBI that you might otherwise not be able to, whether that's harvesting capital losses, capital gains add to your income. So the QBI doesn't purely look at your business income. It looks at your basically the totality of your taxable income as an individual. So if there's things happening on your individual return capital gains that's knocking you out of, that's pushing you past the phase out limit, and you might want to harvest capital losses so that you can get brought down into an income area that allows you to qualify for QBI in your business income. That's an opportunity there. You can be making charitable contributions, so using itemized deductions to lower your taxable income. You could be making significant purchases in the business to reduce your taxable income and increase your QBI deduction. There's another thing on here with retirement plan deductions and having an employer profit sharing or cash balance plan that is a big business deduction that then increases your QBI deduction as well. These things, these decisions all come from tax planning and tax strategy. And there's an interplay amongst all of this stuff, from how much wages that you take, what your retirement contributions are. All these things impact this. And so you need to be doing regular and consistent planning to know what decisions to make to help you maximize the most of this funky and complex tax code. Some other things to be considering if you have some existing vehicles, your existing cars, trucks, SUVs, you can sell your business vehicles with losses, and that will produce a tax deduction. Some people have, vans and trucks and things that they use inside their business. If there's an embedded loss, you can sell it and get a tax deduction for that loss. You can also think about your current vehicle and see if you can qualify for a big deduction. So your current business vehicle, regardless of when it was purchased, could have a big deduction waiting for you. Let's say you purchased a $60,000 vehicle in 2020, you used it 85% for business, and during the 4 years you used it, you depreciated the vehicle $10,000. Well, if you sell the vehicle today, for $25,000, you'd have a $19,750 tax loss. So there's opportunities in your existing cars or trucks. And then there's also the ability to convert your personal vehicle for business. So let's say you start using your personal vehicle for business to claim deductions. And if you're driving an SUV, a truck, you can then get 80% bonus depreciation on what was your previous personal vehicle that's now your business vehicle. So things that you should be doing and thinking about with your existing vehicle. And then there's purchases that you can make of new vehicles this year. So if you're going to invest in qualified vehicles, let's say you purchase a new or used SUV that has that gross vehicle weight rating of 6,000 pounds. If you buy a $100,000 SUV that qualifies and you use it 90% for business, your tax write-off this year would look like $28,900 for Section 179, $48,000 in bonus depreciation, and then $2,400 in the 20% 5-year depreciation schedule. So your 2023 write-off on that $100,000 SUV or Range Rover or whatever you're purchasing, Tesla, what have you, could be as high as $80,000. And then depending upon your business use, and then that $80,000 is this upfront deduction that offsets all this other income. So this needs to happen. You need to place the vehicle in service by December 31st of this year, even if it's only for a day. So there's other 2 tips and techniques. You can buy a new used business pickup truck. Depending upon your business, pickup truck needs to meet specific criteria in order to do this, and you can get full Section 179 expensing. And then there's also electric vehicles. And if you buy an eligible electric vehicle, you can get up to a $7,500 tax credit. And so you take the credit first, then you can follow the rules to see whether or not you get it. There's new rules based on the cost of the car. There's a list of about 22 vehicles that qualify for that credit. And then it also relates back to if you have a pass-through entity, your actual adjusted gross income to determine whether or not you can claim that credit. So a lot of different things to be thinking about. And then there's also a few little things that you can be still doing in 2024 that can impact 2023's tax planning. If you're a real estate investor and you have a property, an investment property that you put in service in 2023, you started renting it out, you can do a cost segregation study in 2024 and still use it for the tax year 2023. It doesn't actually need to get done by the end of 2023 for you to benefit from it in 2023. So whereas all the other topics that we talked about or things that like need to happen between now and the end of the year. These are things that can still impact your 2023 taxes, even though they can happen in early 2024. Retirement plan contributions, basically your employer retirement plan contributions. Profit sharing account, if you have a SEP IRA, a defined benefit plan can potentially be set up and funded after the calendar year. So let's say you have a consulting company that you started last year. You made $300,000. You're the only employee of the company. You could set up a defined benefit plan in January of 2024 for the calendar year of 2023. Put $100,000 or whatever the limit is based on your age and the compensation that you took, to be able to maximize it. Prior to several years ago, you had to have that defined benefit plan in place. You had to adopt it in that calendar year. Now you can actually adopt it after the end of the calendar year, and then you have until your extension deadline of your corporate return to fund that account. So you have until September 15th for a corporation to actually fund the defined benefit plan or fund your profit sharing plan. So from a cash flow basis, you have time. There's also traditional and Roth IRA contributions, HSA contributions that can happen until April 15th. And then for those that did realize capital gains in the last quarter or so of the year, there's opportunity zone fund investments that will allow you to defer tax as long as you reinvest that capital gain within 180 days from the time that you realized it. So this is by no means an exhaustive list, but there's always things to be thinking about and considering. There's nooks and crannies and tax credits and vehicle purchases and retirement plan contributions, but so many different things across your financial life that need to be looked at and considered. So hopefully that helps. And I'll see if there's any Q&A as of now, but not seeing any questions. So, which is great. Hopefully everybody's year end goes extremely well, and appreciate everyone's time and look forward to a happy and healthy and prosperous 2024. And if you ever need anything, do not hesitate to reach out. You can reach me at matt@illuminationwealth.com, and enjoy and talk to you soon. Take care.